Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. As we get everything you need to know in 90 seconds at 9 o'clock with news, investors are out on their own with economic optimism. That may be due to the US Congress already looking at vast new stimulus and rescue funds, just days after passing a $2 trillion package. But the US administration says it's not needed. Back in the real world, the Dallas Fed factory survey was expected to come in sharply negative, but it has come way worse than expected. A huge dive in new orders was behind the very sharp drop. And we get the US non-farm payrolls report this weekend, but due to the timing of the survey, analysts don't expect it to show the full extent of American job losses yet. The weekly jobless claims report, however, due next Friday, will give a more timely update. Also out this week are another consumer sentiment survey and some key PMIs for March. Both are expected to be very ugly. In China, they may be on the other side of their virus emergency, but they're having to face up to an economy that will be very hard to restart without export orders. One analyst expects 18 million job losses there over the next 2 quarters out of a 60 million export-oriented workforce. That is likely to be a major social earthquake. On top of that, more than 2 million graduates are entering their workforce and have zero employment prospects at present. Another huge social risk. Meanwhile, China's central bank cut its 7-day reverse repo rate in a surprise move, taking it down by 20 basis points to 2.20%. That's its largest cut in 5 years. At the same time, it's issuing 2 trillion yuan of treasury bonds, about 3% of their GDP. In Australia, they've announced a huge new stimulus program where almost half of the workforce will receive $750 a week for the next 6 months under an emergency $130 billion wage subsidy. It's a program worth 9% of Australian GDP, as on top of the previous announcements, and takes their total stimulus program to $215 billion or 15% of GDP. The endless stream of stimulus announcements has equity markets excited. The S&P 500 is up 2% so far today. European markets are up between 1 and 2% overnight. Yesterday, however, Asian markets were all lower by about 1%. Perhaps equity investors should wait and to see if any of the stimulus will actually work before taking such big bets. One piece of data that will move markets will be when employment returns, but that seems a long way off yet. US Treasury 10-year yield is soft again today at 0.67% and down another 2 basis points. And gold is down another $17 today to $1,611 an ounce. US oil prices are even lower today, down $1.50 to just on $20 a barrel. They were below that earlier in the day. The Brent benchmark is also lower at just on $22.50 a barrel. The world's crude supply is far more than anyone needs, and the place to store output has vanished. The Kiwi dollar is starting today marginally softer than this time yesterday, now at 60.1 US cents. On the cross rates, we're down by half a cent to 97.5 Australian cents. Against the euro, however, we're firmer at 54.6 euro cents, and that's a 2-week high. That means our trade-weighted index is little changed at 66.5%. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.